is to provide a platform for researchers in the area of broadly defined asset management area. So we can focus on communicating and discussing newer and upcoming papers on this in this area. Um, we have 8 papers in the spring, and as I mentioned, this is our first one. The formatting will be similar as we had in the fall of last year. We'll have 75 minutes presentation. You can type your question in the chat box. I will bring to the presenter. So with that being said, today we'll have E. Lee from the Federal Reserve Board. She's going to present her work on does mutual fund illiquidity introduce fragility into asset prices? Evidence from the corporate bond market. You have 75 minutes. E, please go ahead, and the floor is yours. Thank you.
Thank you so much, Johan, for the introduction. And good morning, everyone. I'm very happy to be included in this virtual asset management seminar series. And today I'm presenting a paper co-authored with Hao Jiang from MSU, Zheng Sun from UC-Irvine, and Ashley Wang from Federal Reserve Board. So since I'm employed by the Federal Reserve Board, I have a disclaimer to make. The views expressed here are those of the authors and do not necessarily reflect those of the Federal Reserve Board or its staff. Okay, let's get started. So over the past decade, open-end mutual funds have grown to become important investors in the corporate bond market. So as of 2019, they hold about, in total, they hold about $2 trillion of corporate bonds. That is about 20% of total amount outstanding in the US corporate bond market. A key feature of these corporate bond mutual funds is that they engage in substantial liquidity transformation by offering daily claims to their investors while holding rather illiquid assets. So such drastic liquidity transformation could generate a first mover advantage among their investors and lead to amplified redemption in response to a negative shock. So the existing literature has shown that asset illiquidity of mutual funds could render them vulnerable to investor runs. What is left unstudied is whether asset illiquidity of mutual funds could spill into the underlying market, in this case, the corporate bond market, and introduce fragility to individual corporate bonds. So to answer this question, in this paper, we first developed a novel bond level measure of latent fragility based on the asset illiquidity of a bond's mutual fund holders. Intuitively, a bond will receive a high fragility measure if it is held mainly by illiquid mutual funds. So there will be more details about how we construct this fragility measure later. And then we evaluate the predictive power of such latent fragility on bond return volatilities and prices, especially in times of market stress. Here is a preview of our key results. So first, we found that corporate bonds with higher latent fragility indeed tend to experience higher future return volatility after controlling for a rich set of bond characteristics. Moreover, we found that these bonds tend to have more outflow-induced mutual fund selling in the subsequent quarter. We also used the recent COVID-19 pandemic for a close-up analysis and found out that corporate bonds with higher latent fragility at the end of 2019 experienced more price depressions and larger subsequent reversals around March 2020. Our data comes from 4 major sources. First, we get mutual fund security level holding data from Lipper Emacs. And we get mutual fund assets under management and cash holding data from CRISP. We merged the 2 data sets based on bond names. And then we get corporate bond transaction and pricing data from enhanced trace, and also corporate bond characteristics like ratings and contract features from merchants FISD. Our sample period spans from the first quarter of 2006 to the first quarter of 2020. As I said, to estimate latent fragility for a bond, we need to quantify the illiquidity of its mutual fund holders' portfolios. To this end, we use three commonly used illiquidity measures for the corporate bond market, including Amyhood price impact measure, the imputed round-trip transaction cost, IRC, and the effective bid-ask spread. The construction of the fragility measure is a two-step procedure. The first step is to calculate fund-level illiquidity scores based on the fund's corporate bond holdings. So for example, if a fund holds 100 corporate bonds, its illiquidity scores will be the average of the illiquidity levels or illiquidity measures of the 100 corporate bonds that they hold, weighted by holding amount. So this fund level illiquidity score is calculated quarterly, and we calculated this quarterly measure for about 4,000 corporate bond mutual funds in our sample. And the next step is to calculate bond level fragility measure based on fund level illiquidity score. So this bond level fragility measure is the average of fund level illiquidity scores of the bonds invested in mutual funds, weighted by holding amount. So a bond will receive higher fragility measures if the bond is held mainly by less liquid mutual funds. It also means that two bonds with the same bond characteristics could bear different latent fragility depending on their mutual fund holders' liquidity conditions.
So we have
Yes.
one question from Vikas Agarwal. Do we need to also take into account the correlation in the liquidity of bonds while calculating the bond portfolio liquidity?
That's a great question. Indeed, later we will address the concern that some of the results could be driven by liquidity commonality. As Vikas just mentioned, the high correlations in terms of liquidity among corporate bonds. And we actually calculate a liquidity beta based on each bond's liquidity exposure to the market liquidity and control for that liquidity beta in our main regressions. And our results remain robust to this inclusion of liquidity beta. So yeah, that's a great question. And indeed, in corporate bond market, people have found that individual bonds have very high level of commonality in terms of liquidity.
Right. I think commonality is what Vikas had in mind and in the comments.
Thanks. So in our baseline model, we use latent fragility to predict a bond's return volatility in the subsequent quarter. And here is our model specification. And we control for bond illiquidity measures as well as other bond characteristics like turnover, credit rating, amount outstanding, coupon rate, time to maturity, returns, same company stock return volatility, and fraction of the bond held by mutual funds. So we will use this set of controls as our standard controls throughout the paper. For our regressions, we control for quarter or time fixed effect, and our results are robust to the inclusion of bond fixed effects. This table shows us the regression results. And it's just that bonds with higher fragility measures experience more volatile future returns, as represented by the strongly positive coefficients on these three fragility measures. And in particular, column 1 shows that one standard deviation increase in fragility measure based on Amyhood is associated with an increase in return volatility by 16% of its median level. Such economic magnitude is comparable or even larger than that from the bond's own illiquidity measures on bonds return volatility. So our results remain robust after controlling for the lagged dependent variable, which is the current quarter bond return volatility. And also, we found that consistent with one's intuition, the predictive power of fragility measures on volatility is stronger for bonds with higher mutual fund ownership. We also find that fragility measures significantly predict future bond volatility for both investment grade and high yield bonds. We did that by looking at the subsamples of investment grade bonds and high yield bonds. And the effects are stronger among high yield bonds, both in terms of magnitude and significance.
So E, we have two questions. The first one is from Kelsey Wei. Isn't it that bond fund liquidity also depends on the coupon income and the timing of such income of the bond fund's holdings? So I think she might be referring to some cash buffer coming from coupon income. And do you guys consider such factor in the analysis? I guess that's.
We don't. Unfortunately, we don't consider the cash fluctuations associated with coupons. But I would imagine that most corporate bonds have coupon payments, like either like half-year coupon payment or quarterly coupon payment, and we have time fixed effects throughout our tests that could potentially address some of that concerns. And yeah, but we didn't specifically look into the effects of coupons, but we do have some tests about how these mutual funds holding of cash and government securities would affect the effect of fragility measures on bond prices. And we can talk about that like when we come to.
Okay, and we have the second question from Vikas. So in addition to strategic complementarities, how much does this anti-stipulatory trading by other institutions contribute to your finding? So I'm not sure exactly what Vikas mean by anti-stipulatory trading. I presume some front running. Is that what you have in mind, Vikas? Right, he said yes. So whether front running by other institutions might contribute to some of those volatility movement in the bond prices.
That's a great question. So yes, mutual funds.
In a sense, the holding information is available, right? So what do you calculate those fragility measure it could be easily observable to other institutions who wants to front run any price pressure, any fire sale by bond funds.
Yeah, that's a great question. And indeed, mutual funds is not the only player in the corporate bond market in terms of institutional investors. Actually, insurance companies, they are the largest holder in terms of holding amount in the corporate bond market. And also pension funds, they also hold about maybe less than 10% of corporate bonds. However, we would argue that mutual funds is the most active trader, like in terms of trying to get profits and insurance companies, from what we observe in the data, their trading is less frequent than mutual funds. And also pension funds, they're more likely to, that their trading behavior is more like insurance companies. And for mutual funds, the special thing about mutual funds is they're subject to investor flows. like especially unexpected and also market-driven investor flows, while insurance companies, unless like in a special condition like during the pandemic or during a tornado, they will have pretty predictable flows in terms of their investment pool and their investor pool. So we would expect that this channel of flow-induced selling pressure driven, this channel of investor flow driving this fair sale is quite unique to mutual funds. But we admit that for insurance companies, there could be some interesting dynamics going on because they are subject to capital requirements. And there have been some papers studying the fair sales for insurance companies when there are large scale downgrades of corporate bonds from investment grades to high yields. There, that can trigger some fair sales of these fallen angels because insurance companies, they're subject to capital requirements when they hold, the most strict capital requirements when they hold high yield corporate bonds.
Okay, thanks. We have one more question from Jae-Won Choi. Is there any possibility that the bond fund holdings and bond prices and risk are driven by some common component, which is like information that the bond fund has?
Yeah, that's a great question. And that's another potential channel that we address later in the paper about like bond funds. They may have superior bond picking ability,
right?
And they will pick the bonds with higher information asymmetry. And that kind of information asymmetry will lead to higher bond return volatility, as well as the higher overall higher illiquidity levels of the fund. And what we observe could be a joint effect of information asymmetry of bond picking ability from bond mutual funds. And we actually have a test on that potential channel.
Okay, yeah.
Okay, thanks. Okay, so a natural question to ask is what drives the strong predictive power of our fragility measures on bond return volatility? So the central idea behind this this fragility measure is the following. Just consider a bond that is largely held by illiquid mutual funds, that is a bond with high latent fragility measure. And when there is a negative shock, investors of these illiquid funds would rush to pull out money because of the strong first mover advantage, possibly forcing the funds to sell the bonds to meet redemption. Such non-fundamental driven selling could destabilize bond prices by generating contemporaneous declines in prices and subsequent reversals. So to flesh out this channel, we designed two sets of tests. First, we test whether fragility predicts flow-induced selling pressure. That is the first link in this channel. Our selling pressure is defined in a similar way as in Koval and Stafford 2007 paper. That is the sale amount from funds experiencing large outflows that is not mitigated by the purchase amount from funds with large inflows, normalized by amount outstanding. Our second set of tests focus on whether flow-induced selling pressure could destabilize bond prices. That is the second link in the flowchart. And this table shows the regression results of the first set of tests. And it shows that bonds with higher fragility indeed have more flow-induced selling from mutual funds over the next quarter. And one standard deviation increase in fragility measure is associated with about an increase in cell pressure by 11% of its standard deviation. And this table shows the regression results of our second set of tests. As it shows that mutual fund selling pressure does destabilize bond prices by generating contemporaneous price declines, shown in the first column, as in quarter T, and subsequent reversals, shown from column 3 to column 4.
E, we have one question from Francesco Fronzoni. Can you please show the summary statistics about your fragility measure, in particular standard deviations of fragility within and between rating groups? Thanks. That's the question. I presume you probably have that in the paper. I'm not sure whether you have in the slide.
Yeah, you are right. We don't have that in slides, but we do have a summary statistics of all the major variables in the paper. We don't have summary statistics by bond ratings, but we do have summary statistics of all fragility measures, bond illiquidity measures for our main sample.
Right. And I think it's interesting to know how the fragility is correlated with some of the basic like correlation, metrics.
Yeah, that's great. Yeah, that's a great point, and we did that too.
Yeah, so I think Francesco just mentioned that my concern is that much of the variation in fragility could be coming from ratings. I mean, if anything, I think you probably control ratings in.
Yes, we did. Yes.
In your regressions. Yeah,
you're right. We control for rating in our regressions. And also we did this our main test by subgroups of investment grade bonds and high yield bonds. So our effects sustain for both subsamples, and the results can be found in the internet appendix of the paper. And so we agree that if you look at the coefficient on bond ratings, there is some effects coming from that, but I believe we've already controlled that. And with the subsample results, yeah, we are pretty sure that our results doesn't just come from very low rated bonds, but is prevalent among both investment grades and high yield bonds.
Okay, thanks. So I have a question regarding this two-step analysis.
Sure.
I think it's interesting. I'm curious about in the second stage you're looking at how flow pressure affects I think price reversal, right? So I'm curious whether in the second step you're doing, can you identify the cell pressure that's related to fragility? It's not the cell pressure, the total variation, because in the cell pressure, some could be driven by other factors, some is driven by fragility. I mean, if you can tease out the variation related to a fragility measure, that would be more convincing in that sense. Does it make sense?
That's a great question. Yes. So now we're just what we're trying to do is just to build these two links. Right. In the second step, we didn't really say this flow-induced selling pressure is comes from the fact that these bonds have higher fragility measures. And we try to convince people by showing the first step that fragility does, as we can see, these measures, they are all very noisy. And each step we will lose some significance or some magnitude due to that noises. But yeah, that's a great question. Definitely we will think about that.
Thank you.
Okay, so with these two sets of tests, we show that fragility strongly predicts a flow-induced selling pressure, that is check for the first link. And selling pressure leads to return depression and subsequent reversals. Let's check for the second link. And together, we provide strong evidence that fragility destabilizes bond prices through the channel of flow-induced selling pressure. Okay, so now let's focus on the impact of fragility in times of market stress. And our question is whether fragility has stronger impact on bond price movements during crisis times. Intuitively, in times of stress, there will be stronger first mover advantage, and that will trigger larger redemption and more forced selling, leading to more price destabilization. So to do that, we first perform a close-up analysis for the COVID-19 crisis around March 2020, during which the corporate bond market was hit hard and bond mutual funds saw substantial outflows, leading the Federal Reserve to intervene with the unprecedented secondary market corporate credit facility, SMCCF. And after that, we conduct a full sample test using 4 aggregate measures to proxy for market stress and economic downturns. So to illustrate how fragility affects bond prices during the COVID-19 crisis, we first group corporate bonds into 3 portfolios based on their fragility levels at the end of 2019. And this figure plots weekly returns of the bonds in the top tercile and bottom tercile in terms of fragility levels. We can see that in January and February, the performance of the high and low fragility bonds actually clustered pretty closely to each other. However, at the height of the crisis, returns on the high fragility tercile dived twice as deep as those on the low fragility tercile. And following the SMCCF announcement on March 23rd, returns on high fragility tercile rebounded more. So this is just an illustration because we didn't control for anything in this chart, but I found it's very encouraging, like in terms of exploring more. Then we perform a formal test by running a panel regression of weekly bond returns from January the 2nd to March 20th. So as SMCCF was announced on March 23rd, that's why we focus on this period. You can see that this setup of model deviates from our previous setups. Our previous setup calculate quarterly return volatility, but here we look at weekly bond returns for the first quarter of 2020. And the variable of interest here is the interaction term between fragility and crisis dummy, with fragility measure constructed at the end of 2019. Crisis is a dummy that equals 1 for the 4 weeks before the announcement of SMCCF. That is the last week of February and the first 3 weeks of March. COVID hit is a dummy variable for bonds issued by firms in the industries that are more affected by the pandemic, because we want to take out the drivers of the fundamentals. And we also control for illiquidity and its interaction with the crisis dummy, as people have shown that illiquidity may play a larger role during crisis relative to normal time, and also other standard controls.
Yes. I have one curious question. I mean, one question. I'm curious when you show the figure. I was curious how the bond flow looked like when you show the chart during this period of time. You know, fund flows, because you know, one key mechanism, you know, you argue is coming from you know, the sell pressure, you know, driven by flows, right?
Yeah. So they look very similar to the to the patterns of bond returns. And so Ida Agustin and one of my colleagues of Antonio Fluffo, I think they, and also another professor, they have a paper on exactly on corporate bond mutual fund behaviors during the COVID-19 crisis. And from their paper, it seems that corporate bond mutual funds suffered about like 10% like cumulative outflows during the COVID-19 crisis in March. So that's pretty substantial. That might be the largest outflow event for corporate bond mutual funds over the past 10 years, at least. So
yeah. Okay, interesting. I'll check that out. Paul Irvine asked whether he can ask a question. Yes, Paul, you want to unmute yourself and ask directly?
Yeah, because it was a bit long to type. Okay, I think this is a great question to investigate, right? This is financial liquidity transmission, and it should have effects. But I'm looking at your panel specification, and is there any effect? Like if I just replaced, you know, we're always such in a hurry to get to the exogenous event, but the way you calculated fragility, wasn't it based on the underlying illiquidity of the bonds? Dumb question, right? So if I just, you know, if I could just replace fragility with illiquidity, would I have any kind of new result?
So in our
what I really want to know is like, what's the extra result of the intermediation transformation? That's really exciting.
Sure, that's a great question. And we agree that it's imperative for us to control for the bond's own illiquidity measures for all specifications. And also whenever we interact something with fragility measure, we interact that variable with the bond's own illiquidity measure as well, just to make sure that we didn't pick up any effect from the bond's own illiquidity levels. So we believe what we document in the paper throughout our specifications is what is not explained by the bond's own illiquidity measure.
I remember reading that. Like, how much do you trust those measures? How confident are you in those, that there's the measurement error in there and that you're really isolating this liquidity transmission effect?
We are pretty confident in terms because of the following reasons. There's a two-step procedure. The first step is to calculate fund level illiquidity levels. And on average, in our sample, mutual funds hold about 80 corporate bonds in their portfolios on average. And then the second step is to calculate for a given bond on the average illiquidity levels of all its mutual fund holders. And on average in our sample, for each bond, we have 30 to 50 corporate bond mutual funds that hold that bonds. So after these two layers of calculation, the effect of the bond's own illiquidity level, we believe has been minimized, because we add in the effect of all the bonds in the funds and then average out all the investing funds illiquidity level for the given bond.
Thank you. Sorry to make you double back on that. I just thought it was important to understand.
Sure. Thanks for the question.
Great. I think we're good. Yeah. We have one more question just popped up from Bing Liang. There are 3 levels of illiquidity: bond level, fund level, and market level. What is the dynamics of this? I think Bing's question is also important during the crisis period, where the market level, illiquidity is quite important, or related to the earlier point, right? During the crisis or COVID period, commonality, in liquidity is probably a driving force in the marketplace. I think, being interested, what are the dynamics it plays out, and how fragility is capturing all of this or any of this.
Yeah, that's a great question. So we totally agree that market variables market illiquidity levels need to be controlled in some way, and we address that issue by having time fixed effects in our specifications. For example, in our COVID-19 crisis regressions, we control for weak fixed effects. Industry fixed effects, which is more like which industry is more exposed to COVID-19. And also in columns 4 to column 6, we control for weak industry fixed effects. That's controlling for time varying exposures of different industries to the pandemic. So that's our control for like overall trend of markets effects. And for the liquidity commonality could be a bigger issue during the crisis. We also can, as I explained earlier, we have a set of tests on liquidity commonality. And we have 2 tables on the how liquidity commonality could drive some of the results during the COVID-19 crisis. Especially we control for liquidity commonality, the interaction between liquidity beta and crisis in our COVID-19 analysis, and our results remain like unchanged basically. So yeah, we agree that liquidity was like a huge topic in the corporate bond market during the COVID-19 crisis, but our results are robust to the control of that.
I think one thought I have is, so I fully understand that you want to control directly the effect of illiquidity. Now, I mean, a small quibble would be, how well do you think those control are? I mean, if in a world where illiquidity, bond illiquidity, return during the crisis period is kind of non-linear, if it becomes non-linear, whether the linear specification we're able to deal with that, right? So, but that's just one thought comes to my mind. But I agree that it looks like you guys have already made a strong effort in controlling the illiquidity directly, both the bond level and market level. Yeah.
Yeah, and for nonlinearity, so we got a comment from our referee. So
okay, good.
Yeah. I mean, from the journal. Yeah, from the journal. And so we actually did something. We control for all the squared terms of our controls, and our results remain robust to that. So that could address some of the non-linearity concern. I would say like great minds think alike. So
great, good to know. Thanks.
Yeah. Okay, so here this table shows results of our COVID-19 crisis. And it shows that bonds with higher pre-crisis fragility levels suffer more price depressions during the crisis. In particular, one standard deviation increase in fragility measure is associated with a decrease in weekly returns from its pre-crisis level by 1 percentage point. And notice that this 1 percentage point is not annualized weekly return. So the economic magnitude is huge. And you can compare that to the COVID hit, the coefficient on the interaction term between COVID hit and crisis, and you will see the magnitude of the fragility measure. And okay, so for the effect of fragility on bond prices after the Federal Reserve intervention, we ran a similar panel regression of weekly bond returns for the 2 weeks before and after the announcement of SMCCF. So here, the variable of interest is the interaction term between fragility and SMCCF dummy. And SMCCF is a dummy that equals 1 for the 2 weeks after the SMCCF announcement. And here our results show that bonds with higher fragility levels have larger rebound in prices after the Fed's intervention. Okay, so given the strong predictive power of our fragility measure on bond return volatility during the COVID-19 crisis, or bond price movements during the COVID-19 crisis, what we did for the COVID-19 crisis is more like a decomposition of like what, because we focus on the first quarter of 2020 and on weekly return. And that's how we calculate our return volatility. We calculate quarterly return volatility from weekly return. And by zooming into this particular quarter, we almost like performing a decomposition of return volatility and how our fragility measures could drive excessive price movements during crisis. So next, it's natural for us to investigate whether in general, the fragility measures have larger impact on bond return volatility for the full sample. To do that, we have 4 aggregate measures. We apply 4 aggregate measures to proxy for market stress and economic downturns, including VIX measure, a flight to safety dummy in a recent paper. That is, when their flight to safety dummy is 1, that means the market is panicking and everyone is having this flight to safety. And it is calculated based on fund flows. So we believe it's pretty relevant to our setting. And also we have probability of recession and the Chicago Fed National Activity Index. So the last 2 measures is more about the overall economic conditions. And we regress the return volatility on lagged fragility and its interaction with stress proxies that we just discussed. So these tables show that the interaction term between fragility measure and the stress proxies deliver consistent results. It shows that fragility has a stronger effects on future return volatility when markets are more stressed and during economic downturns. Okay, so we also perform a battery of additional analysis. And so first, we explore the asset pricing implications of our fragility measure. Next, we address some potential concerns about alternative channels that could drive our results, like liquidity commonality and information asymmetry, as pointed out by the audience. And we also talk about whether funds liquidity buffer could mitigate the fragility effect. Okay, let's look at them one by one. Okay, so far we have found that latent fragility strongly predicts excessive movements of corporate bond prices, especially during crisis. So it's possible that some sophisticated investors know that, and they may require higher returns out of bonds with these higher fragility measures. That leads us to one of the fundamental questions in the corporate bond literature, that is how corporate bond returns and the yields are determined. Existing literature has found that credit risk, liquidity, and volatility are all important determinants of bond pricing. So here we investigate whether fragility offers any additional explanatory power for bond returns and yield spreads after controlling for these known factors. So in this table, we regress abnormal bond return on lagged fragility. And it shows that 2 out of 3 of our fragility measures have strong and significant predictive power for future bond returns. And here we have a similar test on bond yield spreads. In particular, we regress change in yield spreads on contemporaneous change in fragility measures. As yield spreads are highly persistent, that's why we calculate the quarterly change rather than regressing the absolute level. And again, consistent with our results on bond returns, 2 out of 3 specifications deliver significant results, suggesting that increase in fragility levels is associated with increase in bond yield spreads. So these 2 tables provide some evidence that this fragility measure has at least has some asset pricing implications after we control for the other well-known factors that determine bond prices. Okay, so next we address the potential concern that our results are driven by liquidity commonality. As I mentioned earlier, the literature has documented substantial commonality in corporate bond illiquidity. This strong co-movement of bond illiquidity might imply the following. So for bond A, the aggregate illiquidity levels of other bonds held by bond A's investing funds could contain some information about bond A's own future illiquidity and something beyond that, thus driving bond A's future volatility. So to address this concern, we first conduct rolling window regressions to estimate each bond's exposure, time varying exposure to market liquidity, that is liquidity beta. So our intuition is that if liquidity commonality drove our findings, we would at least see that the predicting power of fragility for volatility be significantly weakened after controlling for liquidity beta. And to see if that's the case, we include liquidity beta to our main regressions. And it shows that fragility measures continue to predict bond volatility in most specifications, even in the presence of liquidity beta. And also to address the remaining concern that liquidity commonality is a bigger issue during crisis time, we also repeat COVID-19 analysis by controlling for liquidity beta and its interaction with the crisis dummy. Our results are barely changed compared to our baseline results. Okay, another potential channel that could explain our results is if our is information asymmetry. The intuition is like this. So suppose mutual funds, they have better information collecting skills in terms of like picking bonds. They will self-select to hold bonds with information asymmetry. And these bonds will have higher portfolio, and these bonds will naturally have higher volatility. And also because of the fund's information collecting skills, their portfolio would tend to be more illiquid compared to other funds. That is, mutual funds information collecting skills could lead to both our left-hand side variable and right-hand side variable. So under this information asymmetry channel, we should expect more return continuation for bonds with higher fragility. As now fragility is not just fragility, it's an indicator for skills. As price adjusts to private information gradually. However, under the selling pressure channel that we documented earlier, we should expect more return reversals for bonds with higher fragility, because we are talking about this overreacting and then correcting mechanism here. So Our test focused on whether bonds with higher fragility have more return continuation or return reversals. And here our regression results show that bonds with higher fragility measures experience significantly more return reversals over the next quarter. Our results are not consistent. That means our results are not consistent with information asymmetry channel, but more supporting the price destabilizing effect of sell pressure. Okay, finally, we consider funds holdings of cash and government securities if they could serve as a buffer to absorb the fragility effect. Intuitively, if a fund holds a bunch of cash and government securities like treasuries, when they have some outflows, they can just simply resort to cash or sell some of the liquid government securities rather than selling their less liquid corporate bonds. And that could mitigate, intuitively, that could mitigate some of the fragility effect. To test this, we construct a bond level liquid holding measure. That is the average liquid asset holdings of bonds mutual fund investors. And a higher liquid holding measure means that the bond is on average held by funds with more liquidity buffers like cash and government securities. Our regression results show that indeed, holding of liquidity buffer could mitigate the fragility effect we documented earlier, as represented by the strongly negative coefficient on the interaction term between fragility measures and liquid holding measure. Okay, I will conclude with a summary of the main results of the paper. So in this, yes.
Before you summarize, I have one thought and related to the COVID analysis. I think one of the key mechanism of this fragility measure is that strategic complementarity, right? So during the COVID period,
yes,
you have evidence, or maybe the paper, the other paper by E.T. Gosling have already done so, to show that indeed for funds, for bond mutual funds with more illiquid assets, you see there are stronger outflows out of those. I mean, to show the macro mechanism exactly, there's a kind of a investor run on those funds.
Yeah, you're right. That's a great question. And I should discuss more about that during the COVID results discussion. So indeed, the paper by Itai and my colleagues, they show that less liquid mutual funds suffered more outflows during the COVID-19 crisis. And there are earlier papers by Itai and my co-author, Hao Jiang,
right.
That is, in general, corporate bond mutual funds that are less liquid could suffer more outflows in the face of negative shock. So I guess these results from contemporaneous and earlier literature is consistent with our finding the market price effect. Yeah. Okay. So in this paper, the key question we try to answer is whether illiquidity of mutual fund holdings could introduce fragility into corporate bond prices, and through what channel. To do that, we create a bond level latent fragility measure based on the bonds investing funds asset illiquidity levels. In the paper, we found that corporate bonds with higher fragility tend to experience higher future return volatility, and identify mutual fund outflow-induced selling as a major channel of such price destabilizing effect, while addressing the concerns for two alternative channels. We also document that such effect could be mitigated by funds' liquidity buffers. During the COVID-19 crisis, bonds with higher latent fragility at the end of 2019 experienced more destabilizing price movements. And finally, in face of such price destabilizing effect of the fragility measures, investors in general require higher returns on bonds with higher fragility. Okay. That's yeah, that's all I have.
Great. Thank you, E. I think we are ahead of schedule a little bit. That's always a great thing in our current period of time. So I want to open the floor to the audience.